Welcome back. It's the last hour of the week and it's turning out to be one that's seeing deep cuts. The cuts have been on right from the morning, actually. And now the Nifty is staring at a decline of about 315 points. The low of the day is 24,824. We're right there. What happens in the next 60 minutes? Do we bounce? Or does this slide get deeper? We'll have the answers. This is Closing Bell. I'm Surabhi Upadhyay. With me on the show, as always, Reema Tendulkar and Nigel D'Souza. Hi, folks.
Do you think we're going to bounce?
I don't want to answer that loaded question, but I can tell you this, and we'll discuss
You're going to bounce at 3:30.
That we'll discuss later. Work's not done yet, thanks to the fact that this whole FBI matter is really outstanding and pending. And we'll discuss it. I've been working the phones, trying to get some idea about whether this is really such a huge issue for the market, or is this just non-farm payrolls jitters. I think the truth lies somewhere in between.
Global markets had sold off from Monday to Thursday, and Indian markets were under pressure, but we just didn't have that kind of a sell-off. Even when it's Asia or Europe, the cuts are so much deeper if you look at it on a week-to-date basis.
Indeed, but I'm an optimist, so I think that we'll defend the 24,800 mark. No valid reason out there, but I just think that from these lows, I think, the buy the dip has happened. Till now, it's not worked. We have 60 minutes to go. Let's see whether or not we can get some tinge of green on the, in terms of a recovery from the day's low. But otherwise, it's been a painful trading session because the advanced decline ratio for the first hour, it was way more number of stocks advancing than declining. And now the declines are outpacing the number of advances. Yeah, just take a look at that. Crisscross and how they're moving apart now ahead of the weekend.
And there's no respite in the small cap index. So far, at least every single day, the small cap index used to manage a close in the green, even as the frontline indices were dithering, pausing. But today, small cap indexes too, down a similar 1.33%.
Absolutely. I mean, the decline, while the mid cap market obviously is sliding, but the large cap fall is something that you can't really ignore, because at this point in time, Bank Nifty losing about 800 odd points. Not just that, I mean, even if you go beyond the banks, there are big stocks there which are feeling the heat. There's ITC, there's Reliance, which is down by about 2%. So for me, it's going to be really interesting to see what is the FPI or FII number today. And here's the chatter. More on this as we go along. But the whole chatter is whether the selling that we are seeing today is accentuated because a certain category of FPIs which were non-compliant with the so-called August 23 circular, whether they are selling. What did that circular say? That there were some deadlines that were announced that if you don't comply, then either you disclose all the details of the beneficial owners or you pare down your holdings. And if you are going to be in breach, then you just sell down your business in India, shut shop, wind up and leave. And that deadline is today. Monday onwards, they have to be compliant. So we'll discuss this as we go along, but it's definitely playing out quite a bit on the large cap screen as well. How should you position yourself, given that we have 60 minutes? Should you take that contrarian call and look for a bounce? Well, let's ask Mitesh Thakkar. Mitesh, hi, good afternoon. Not been the kind of end to the week that the bulls would hope for, but what would your strategy be now for the last 60 minutes?
Yeah. So, today morning I was talking about the fact that the market will possibly head towards the lower end of the range, which is about 24,850. And now we find ourselves just below that. And the situation is that even the daily charts have started getting, weakening. So assuming we break 24,800, there's some put concentration over there being a round number strike. There's a good chance that I think, the market will go slightly corrective. And then we might look at a slightly deeper cut, possibly to about levels of 24,300, 350 zones. So I'm cautious. I'm not trading much on the long side and totally avoiding any kind of long trades, you see. Having said that,
yeah, Mitesh, but so what's the level to track on a closing basis you said for today?
So 24,800, Nigel, we'll just take that as because there's some put open interest over there. We'll take that as the round number. The 24,850, 830 was the support zone, but 20, 30 points intraday violation can be okay.
All right, but individual stocks is something that you're focusing on. So let's get straight to that.
Yeah. So on the stock side as well, we are looking at identifying some kind of negative ideas because we've been trading with long bias till last many few days. So right now I have a sell on HDFC AMC for targets of around 43.50 and a stop at about 44.60 can be looked at. While I have a buy on Hero Motors, and we have had buy earlier as well, even now looks good. So Hero Motors is a buy with a stop below 5700 for targets of 58.50.
Okay, but not all is lost for the week. Hero Motor Corp, which Mitesh was telling us, has moved up 5.5% this week. So that's been the top weekly gainer on the large cap space. And then you've got Asian Paints, which has also moved up 4.5%, given the fall that we've seen in crude prices. A couple of these other, consumer-related names, Titan, HUL also managing, probably likely to close in the green for the entire week. And Bajaj Finserv, a beneficiary of, the monetization done by the Bajaj Group, Sanjeev Bajaj Group, in terms of Bajaj Housing Finance. Bajaj Finserv too has notched up a gain of close to about more than 3% for this week so far. Prakash Diwan is now with us on the show. Prakash, Hero Motor Corp, that's been the big winner for the week.
Well, absolutely, Rima. So I think it's probably starting to behave in accordance with the anticipated uptick in demand, especially some of the indicators early, of course, but did indicate that rural demand would probably come back post the monsoon. And tomorrow onwards, you have the start of a long festive season, usually which works well for them. And the best part is they've really not had any competition in terms of new launches that could upset this entire festive buying. So in that perspective, it's pretty good to see that it'll probably outperform itself in terms of relative underperformance that it did. But don't expect fireworks. I did mention about Hero Moto being more suited to this demand revival about a month and a half back. And this is exactly what we were anticipating. So this could continue for some more time, at least for the next quarter or two.
Well, that's played out very well for Hero Motor Corp. In the last 1 month, we've seen the stock price move up from levels of near 5,000 rupees now to 5,700 thereabout. But let's get to the big movers of the day. And one of them is Nimesh is now going to be joining in. You've got stocks like SBI Cards, Vodafone Idea. They're all starting on the back of fresh brokerage notes. So Nimesh and Abhishek are with us from the research team to discuss them. Nimesh, first, the Goldman Sachs note on SBI Cards. That's a double upgrade there.
Yes, Rima, technically it's a double upgrade. So they've upgraded the stock to buy from sell, and they've raised the target price as well. I believe the stock is also reacting because it's a kind of an anti-consensus buy from Goldman Sachs on SBI Cards. Now, why I'm saying is because there are 26 analysts who track SBI Cards, but only 6 analysts have a buy rating on SBI Cards. And within that, now after today's upgrade, Goldman has become the most aggressive as far as target price on SBI Cards is concerned at 913. If you look at the average of all the other brokerages, it works out to close to 700 rupees per share, which means around at least a 12% downside from current level. So that's the reason why I think stock has reacted sharply in today's market. Now, coming to the Goldman note on the thesis on why they've upgraded the stock, they believe and they see that the PPOP and ROA they are bottoming out, and it's only going to see further improving visibility from here on. Their upgrades are based on few theses. The first thesis is SBI Card specifically could see a nearing of its peak in terms of credit cost over the next couple of quarters. Second, improving the cost to income ratio with the consolidation in the industry. And the third and the most important is the valuation front. The stock has got derated from 36 times 1 year forward multiple to now almost 24 times on 1 year forward. So that's been the key reason. So on back of all this, Goldman Sachs has raised the EPS estimates for this year for 25 and 26 by 7% and 21%. Now, going forward, they're saying that they're expecting improvement in the cost-to-income ratio by almost 400 basis points. They expect improvement in the credit cost from second quarter of this year. And third, they believe that there will be a pickup in the loan growth as well in 25. So on back of all this, a double upgrade from Goldman Sachs. And that's the specific reason why the stock is reacting sharply today.
Thank you very much for that. On the other hand, Goldman Sachs today has downgraded its rating on SBI. Abhishek, what's the key reason?
Well, another, brokerage house has turned negative on SBI. So we begin with Macquarie, which has an underperformance rating and 690 target. UBS has a sell call of target with 725 per share. And Goldman Sachs, now they have downgraded the stock to sell with a target price of 742 per share from the earlier target price of 841 per share. Citi also has a sell rating, target price about 720 per share. On the other hand, you have few bullish MNCs as well on SBI, like Nomura, which has a buy rating, target price of 1,030 per share. Jefferies has a buy rating and 1,000 rupees target per share. And JP Morgan, they have an overweight rating and a target price of rupees 1,000 per share. Now, Goldman Sachs has highlighted few key points which are making analysts being very off, being bearish on SBI, given the fact that they expect the company's ROA, which was more than 1% in FY24, to be below 1% by FY26. So that's a key reason why they have downgraded SBI, and they believe that credit cost trend would be on the upper side or would move up from here. And they say that the bank is continuing to lose market share, especially in deposits over the last 4 quarters. So they expect lending growth to moderate, and hence they see that the growth assumption is actually cut by 100 to 400 basis points over the next few fiscals. They expect increasing credit costs on rising slippages in the MSME, agri, as well as unsecured loans, and that is why they cut their EPS estimate by 3% to 9% over the next few fiscals, that is FY25 to 27, and reduce the target multiple or the valuation multiple of price to book value to 1x from 1.2x that they had earlier on SBI. Back to you.
Okay, thank you very much for that. And let's talk about Vodafone Idea, because that's where we've seen the biggest fall today. Now, the key variable when it comes to Vodafone Idea is what happens to that curative petition which has been filed in the Supreme Court on the AGR dues. The AGR dues for Vodafone Idea stand at 70,300 crore rupees. According to the company's own assessment, the AGR dues should be half of that. So if the Supreme Court gives a favorable verdict on it, then the AGR dues come down, and that could be a big positive on the stock price. So that is the key variable. But today you have Goldman Sachs, which has come out with a base case, and their base case is that the AGR dues do not change from here on, and their target price is 2.5 rupees on Vodafone Idea. So there's no change in the AGR liability. Their market share continues to come down 300 basis points according to them, and they're saying that if the company has to meet its cash flow requirements, because we are assuming that the government doesn't convert its debt into equity, we are assuming that the AGR dues don't come down, then their ARPUs need to go up from less than 150 rupees to 446 rupees per month by FY27, which of course seems like a very, very low probability event. But Goldman Sachs, in a bull case, has put the target price at 19 rupees, where their market share remains intact and their AGR liabilities come down. But before that, there were quite a few brokerages who were bullish on Vodafone Idea. So there was a Citi note. They had upgraded the stock way back in July. Their target price was 22 rupees as a base case, 28 rupees as a bull case. And again, they're saying that if the AGR verdict is positive, then it can add 4 to 5 rupees to the share price. So the street is still very, very divided on, Vodafone Idea.
I guess it's because of the nature of those hard numbers that
High
Goldman
risk,
has.
high reward.
Yeah, but I mean, when they talk about the riskier side, they put out such hard numbers, and you've picked them out beautifully as well, that you need this kind of a gigantic, next to impossible, nearly impossible increase in ARPU to sustain free cash flows. And, the kind of market share erosion that perhaps is staring Vodafone Idea in the face. So those numbers are pretty hard.
I spoke to one analyst, and jokingly he said, the target price for Vodafone Idea can be anywhere between 0 or 20. It's like, you can come up with a case for, 0 to 20.
It was always like this options play, right?
Yeah.
I mean, 0, 1. That was always the case, but the market was veering more towards the optimistic side. And now suddenly we have a big, big bearish call. Let's go back to Prakash, because some of these brokerage notes are really very interesting today. So Prakash, one by one, give us your take on Vodafone Idea, and then let's come to SBI Card. SBI Card has been the market's favorite whipping boy in some sense, right? But here's a positive call, and then Voda is a negative one. So let's start with Voda first.
So, Surmi, as a matter of disclosure, I do have interest in this name. And I just want to remind ourselves of the fact that Goldman Sachs already had a target which was about 2.22 rupees 20 paisa. It's just that they've in fact increased that target. So it depends on how you look at it. They were always very pessimistic about this. But I also get surprised that when we had the 11 rupee priced FPO, there was no news about this. There was no talk about all this. It's just that, and nothing much has really changed after that. In fact, things have only improved Vodafone in terms of its balance sheet health and all that. And all these facts that have been highlighted as which you call these hard numbers, that was always known. So I think it's just a matter of beating down something with a logic which seems plausible. And as Rima said, you could justify 20 rupees if you wanted to look at the brighter side of things. You could justify, 2 rupees or whatever if you wanted to look at the darker side. So it's always going to be slightly divided in this case because the company is yet to get out of the way. So all of us know that. I would really take this very seriously. I would rather wait for developments on the AGR liability in terms of how they are looking at bolstering their, while they might lose market share in terms of their ARPUs being still intact. So those are interesting things that could kind of this thing. And very clearly, the bankruptcy risk is out of Vodafone. So it will stumble along. It will kind of, keep falling once in a while, but it will plod along and do business. So that's what you need to look at. On the SBI cards, so can I go to the SBI cards part because that's diametrically opposite?
Yes, absolutely.
Yeah.
Yes.
So I'm not a big fan of this business for the simple reason that the competitive intensity from fintechs and alternative payment platforms and mechanisms, and look at what usage are we talking about. It's definitely a very vast market, yet very underpenetrated for the likes of SBI cards to reach, especially with co-branding, co-badging, all of that. But it doesn't really mean that the business is going to be so promising that you get excited for it. So it's again looking at the glass half full in this case, unlike the other one where they wanted to look at the glass almost empty. So I think it's very subjective, but I'm not a big believer in this fact that SBI cards could kind of zoom itself to glory. Especially, there have been so many exits from people who understand this business and have been there right from the start. So, you need to kind of see that as well in context. I would be a bit cautious here in terms of the optimism.
By the way, this week, we've also seen housing finance companies perform very well. So today is Aavas Financiers, again a brokerage note here. But the stock has gained 9% this week, of which 3.5% has come today. But even Aadhar Housing Finance, again a brokerage note. So now that Bajaj Housing Finance is opening next week, it's put the spotlight on many of these housing finance companies. And maybe there is a bit of a valuation catch-up taking place. Prakash, anything in the housing finance companies that you like, or would you put your bets on the big one, which is opening next week?
No, so I'm sure, it's well priced. Bajaj Home Finance is not going to leave much, except for long-term investors could kind of benefit. So from an IPO perspective, I don't think there's too much of fireworks here. But my sense is the entire space is getting a lot of respect back for the simple reason that with interest rates probably peaking out at some point in time, end of calendar 24, you'll probably see a very benign cycle emerge in terms of, loans kind of getting to expand and then the spreads to start getting much better. Now, what happens is when a company like Bajaj comes up with the spotlight is, as you rightly said, on the sector, a lot of metrics get debated, discussed, evaluated, and a lot of the companies, existing companies, find themselves in a very good spot in that sense. So look at PNB Housing Finance. After a big exit from a P side, you actually had that supply getting absorbed and the stocks done so well post that. So this is what happens when core businesses are intact. And from that perspective, I don't see any reason why Aadhar, which is, to my understanding, discussed, under discovered of sorts, because it doesn't have too much of a history in the listed space. It offers a very good balance in terms of growth and valuation. So you'd rather look at something like this rather than pay top dollar for something which has a very strong brand and is likely to, of course, do well, but doesn't leave much on the table with the Bajaj Home Finance stock as much as with a smaller company like Aadhar.
Okay, all right. Hi, Prakash. Good afternoon and always good to see you. And, I'm struggling to see any stocks that are in the green, but one such stock is PI Industries. It's up close to around 2.5%. And the reason is that Kumai came out with a set of numbers earlier today. Good revenue growth is what they've given. The margins as well have improved from Kumai. And also the key drug, I'm going to struggle to pronounce it, so I'll just leave it at the side. Pyrosulfone, that's the one. Oh, there, year to date, there is a bit of a degrowth. But for the last quarter, there is a growth. So it seems that Street has taken heart from that. And that's why PI Industries is at the high point of the day. What's your view?
No, so good afternoon, Nigel. So I'm quite positive on PI, even from the time where, there was this whole bottoming out of sorts because a large player, had decided to stop making a particular variant of this thing, product, which PI also is big time into, and that probably meant that because there was very low demand for that product, and that was likely to impact PI. But PI came up with a very clear explanation that they have a far more diversified portfolio. They don't have to depend only on a couple of these complex sounding names, but the growth that is likely to come is something within the chemical space. It's probably already visible in specialty chemicals and a little bit of this thing on the agrochemicals. And the reason I can tell you what is happening is that there were regions where there's a lot of destocking that happened, and all of those, especially Brazil, Latin America, parts of Europe, if not in the entire European continent, you have restocking happening now. Now, for that perspective, it's very simple that the restocking is happening with different formulations. It's not the old formulation. The generational change that's happened within a lot of chemistry is also at work, and PI actually stands to benefit from that. So when the restocking happens, these are companies which will actually be off the blocks much earlier, much faster, much stronger. So I'm quite positive on PI in terms of the setup where it is. You may not have seen great volume surge, but the pricing is coming back. The margins will follow, and of course, volumes will towards the end start justifying all this exuberance. But yet not into that territory, but I'm sure this is the turning point. So PI is definitely something which, from a longer term perspective, could look at.
Okay, got it. Prakash, thank you so much for joining in. Good to have you on. You go ahead, enjoy your festive weekend, and we look forward to connecting again next week. Have to take a break on that note. We'll come back on the other side, and Alok Agarwal of Alchemy Capital Management will join in with some market perspective.
Welcome back. Still no recovery in sight, but the Nifty is holding on to 24,800 on the way down. still down 300 points. It's time now to get you a CNBC TV18 exclusive. Now sources say the government is considering FAME incentives for electric ambulances and police vehicles. Pariksha joins in with the details.
Well, officials have been working on the third phase of the FAME scheme for several months now. And the idea was to broaden the scope of the fast adoption and manufacturing of electric vehicle schemes from just two-wheelers, three-wheelers, cars for the fleet segment, and buses to even electric trucks, electric tractors, and electric mining equipment. Now we believe, after an interministerial meeting where officials from the Prime Minister's office were also present, the feedback is that e-ambulances, electric police vans or cars must also be included in the scheme. So it is quite possible that in the next few weeks, the government may come out with a final draft or final proposal where electric ambulances and electric police cars may also be covered. Now, when it comes to vehicle scrapping, now this is a priority area for the government, and it is being thought as to how an electric vehicle buyer can get more incentives by scrapping his old end-of-life vehicle. And these would be incentives over and above the incentives an EV buyer already gets via reduced GST of 5% on an electric car and also a road tax exemption. So that is something being thought about. Thirdly, the feedback that is coming in is that the government has not been able to communicate very well as to how it has been working to promote electric mobility in the country and how FAME subsidies are helping the electric mobility transition. So they are in talks with OEMs whereby a certificate may be issued to the EV buyer which will show that this is a FAME subsidy being given by the central government and will show the amount of subsidy as well. Now all these three issues are under works right now. We believe that the final outlay of the scheme could be anywhere between 10,900 or 11,000 crores. The final outlay, the numbers are yet to come out. Trucks are likely to get an allocation of 500 crore rupees, and the outlay is for 2 years and the incentives would be staggered or lowered. Finally, in case the FAME scheme is not brought out this month, then the temporary EMPS scheme, which was extended till the end of September, may get a second extension till the FAME 3 is formally rolled out.
Okay, all right. Interesting one. Thanks a lot, Parikshit, for joining in and giving us that quick update. Well, let's get in our market master today. We have, Alok Agarwal, Head of Quant and Fund Manager at Alchemy, who joins us. Hi, Alok. Good afternoon and good to see you in. Thanks a lot for joining in. Well, I wanted your comment first on this. Yesterday we had Bhavesh of Ola, and he sounded very, very aggressive with regard to gaining market share, improving margins as well. How are you all seeing this EV theme? Will you all go with the larger players, who already have a strong base and now they're getting into the EV, or are you looking at the core EV players, namely Ola and the likes?
One thing is sure for Nigel, that EVs are here to stay. They will be, the ride across will be seen. The government is supportive of that. There have been a lot of schemes around supporting it. For the companies which already have a lot of cash flows coming in from the ICE vehicles, they need to obviously crack their minds as to how to ensure that they gain market share on the EV side as well. Meanwhile, as you mentioned, some of them are already taking long strides and ensuring that they capture the market at the initial stage itself. So as we see, this is an evolving stage, but the growth going forward over the next 5-7 years is definitely in favor of EVs.
Okay, so EV is one space that you'd look at favorably. What about Alok? Hi, good afternoon. Good to have you on. What is the stance you're taking on the rest of the auto space overall? Because, we were just discussing this earlier as well. Numbers have started getting a little muted for passenger vehicles. CVs are failing to show up in, excitement. It's just the two-wheeler sales which are holding up well. Do you think this is only a temporary patch and therefore one should be buying any dip in these stocks? Or do you think this is a slightly longer, maybe cyclical downside period that we're getting in?
So, Surbhi, if you look at the last couple of years, we had a great time for the auto sector, both on the two-wheelers as well as on the four-wheelers front. But right now, if you look at the overall inventory levels also, they are also at a multi-year highs, almost all-time highs, in terms of the number of days of inventories that we have. So there could be some consolidation, there could be some kind of slowdown in the profits in the near term. But going forward, it is one of the key discretionary spend items for Indians. And yes, we have to be picky and choosy around which areas that we look at. As we said, that those which are being able to generate higher volumes, gaining market share in these kind of markets, and that profitably, that's the area that we are looking at.
Okay, so that's the word on the auto space. Alok, what else? What else are you changing in the portfolio at all? And what are the top overweights or the biggest bets for you at this point in time?
Frankly, we are more overweight on the domestic cyclical side, although yes, some of them are facing some correction of late in the last few weeks or something. But after a big run that we have seen in some of them in the last 12, 18 months, some bit of consolidation after that cannot be ruled out. But our starting point for narrowing down on stocks and sectors is the growth, the heightened growth, and the certainty of that. And we see that part coming primarily from the capex-oriented names, the cyclicals, and the discretionary side. So that's the area that we are looking at. We are more favorably adding weights in those kind of sectors. And the others which are possibly not growing at a faster pace or possibly were growing faster in historical times, but going forward doesn't look like growing at a great pace, they are the ones we are underweight on.
Alok, if I'm not mistaken, I think you'll have Trent in your list, right?
Yeah.
Congratulations. I guess you all got in early out there. But what's the view right now? One would say it's gone out of whack, but one would say it went out of whack at 4,500, at 5,500, and even at 6,500. But it just continues to move northward, and now it's got that tailwind that is coming in the Nifty. So funds will have to allocate purely because they want to replicate the Nifty. Your view on this one? It's been a big winner. Due disclosures are taken on board, but tell us.
Yeah, precisely, Nigel, that this has been a big winner for us. And, aside the valuations, nothing else is wrong in this one. So they have executed extremely well, both on the growth front, the way their studios have done well, where their websites have come back. The profits have multiplied nearly 15 times in the last 3 years. Valuations definitely on a higher side. It was expensive a year ago. It is expensive now. But one of those rare retail companies that have really cracked the markets properly, they have grown both in volumes as well as on margins and gaining market share. You don't often see companies and stores having queues outside their stores and without having much presence online. So they have done something really right. And we, as we said, our stock picking, our allocations are more based on companies that are executing well. They are having higher growth, and not just higher growth, the visibility of growth going forward is good because of the kind of strategic decisions they have taken. Capital allocation remains good. So those aspects have been pretty good for us. It is still a part of the portfolio, and some few of the portfolio is actually one of the top holdings.
Okay, all right, Alok, appreciate you stopping by and filling us in with your views. We look forward to chatting up with you quite a few times. I was looking through your list and quite a few winners in there. HAL, Trent, REC. Thanks a lot for joining in. Wishing you a good evening and a good weekend ahead as well. Well, I think what we'll do on that note is we'll slip into a short break. On the other side, Nimish is waiting for us. He'll tell us what's going on in dealing rooms as the markets have moved to the low point of the day. We'll also get you some technical calls. Stay with us. Okay, holding with gains. The good news is we're not breaking down further from the time we started off the show. So I'll take that as a positive. The Nifty Bank, we can just pull up the 20 DMA of the Nifty Bank with today's chart. That will tell you the picture. The Nifty Bank has broken the 20 DMA, I think, by close to around 200 points now. So you'll want it to end closer to around the 200 DMA and give us some hope that maybe the overnight cues are positive. That one's breaking down, and that's the heavyweight, and that's the problem from a bullish perspective as well, because any kind of bounce is being sold into. That's what we're talking about. That's the 20 DMA. We're mildly below that, 200 points lower out there. Mitesh is back with us. Mitesh, you told us you're not expecting any kind of bounce from here. A little bit cautious on the index, and we are holding that support level that you were talking about, 24,800. But fresh trades, what do you have for us?
So, it's very difficult to say whether tomorrow we'll have a gap up or gap down, Nigel. But I think I'll go trend, because the fact that we are closing weak, we will assume that, possibly a chance of continuation are slightly on the higher side. So, Indus Tower is something which I would recommend a sell upon with a stop at about 430. Look for targets of 405 on the downside over here and maybe more. I think we have had some negative brokerage upgrade as well as the chart pattern is suggesting profit booking setup. That's the way we'll take it. And Lawless Labs is something, which is given a pullback is close to support area. So would recommend a BTST with a stop at about 476 for targets of 490.
Okay, all right. Thanks a lot for that, Mitesh. By the way, keep an eye out on Godfrey Phillips. Smoking hot. They announced that corporate action in the next few days. The stock is now up close to around 13%. It's in a world of its own. The street believes there's going to be more amount of liquidity. And hopefully the promoter entity as well, they come to a common understanding. But for the time being, post that corporate action that was announced earlier today, the stock is flying away. As promised, let's go to D Street Chatter. Nimesh joins us to tell us what's going on. Nimesh, some nervousness on the screen. Nifty Bank lower, Nifty lower. It's a sea of red, so to call it.
Well, today is a classic day of cocktails of a lot of things, right? The Friday factor, the fear of that FBI closure, which the deadline was today. Some noise about political changes as well. All has led to a bit of underperformance, and that's largely led by the large cap names. I guess there is a bit of nervousness as well out of the crucial macro data from the US tonight. So put all together, the fall is largely led by large cap names. Interestingly, the mid cap and the broader markets are relatively outperforming. On a day when the Nifty is down more than 300 points to have an advanced decline of 1:2 on the decline side, not a bad thing or not a bad outcome, so to speak. And there is a bit of interest as well from larger HNIs and retail money into the broader market stocks today. So that speaks the outperformance in the broader market stocks. Technically, I think 24,800 is a very crucial level to watch out for on the downside. If that gets broken down, then you will see further selling in the broader market stocks. So that's the overall feedback. But from a flow perspective, it's a combination of a lot of things. Because some large blocks, this FPI disclosure, which will lead to a bit of could be a large number from the larger FIs today. But broadly, I guess today's fall is largely large cap driven.
No, absolutely, Nimesh, take that point. I mean, look at the Bank Nifty now. It's a bit of a crunching fall, 900, and it's been a one-way decline. There's been no buying that dip. That's just not played out today. And even as we're speaking, coming down to the last 20 minutes of trade, the fall is not ebbing. Just to quickly add my 2 bits on this whole FPI matter before we discuss stocks with Nimesh. Essentially, in a nutshell, the issue is that as this August 23 circular was being implemented, the circular essentially spoke about granular, very detailed disclosure so that the regulator is aware about the last man standing or woman standing, last mile disclosure as to who's the beneficial owner. And whichever funds were not in compliance, there was first a 90-day window, then there was a 30-day grace period, and if funds were still in non-compliance, then they had to forfeit their India licenses and sell down their holdings, wind up their India business in 180 days. And that 180-day deadline is what has come to an end today. So from Monday, which is the 9th of September, they need to wind up their business or pay a 5% penalty. As the rule stands. Now, that's on one aspect. The reason why none of this is new. All of this has been known for the last many months. So then why this chatter and the volatility today? The reason is that quite a few FPIs were seeking exemption from the purview of this particular notification or this circular. they claimed, or they said that they had met the exemption criteria, but then SEBI went ahead and changed this exemption criteria. I'm not getting into the technical details, but there was a change there. However, the changes were not notified, argue a section of the FPIs, and basically because of this whole back and forth and this confusion, the matter was in limbo. So while there was no clarity on who is getting the exemption and who isn't, the timer was ticking and the deadline was approaching, and here is where we are. In fact, we're going to get an expert on this to really help us demystify whether this is really a big overhang on the market, or does this impact only a very few number of FPIs. More on this in a bit. But Nimesh, let's get back to individual stocks. The market is under pressure, but what about the individual names that you've picked up the chatter on today?
Yes, so in terms of individual names, the first stock is Indigo Paints. Clearly the stock of the day, large block, 25% equity has got changed hands today in a block deal. We were aware of the fact that the Sequoia Capital, which has been renamed as Peak Investments, they were the sellers in the block. They were to sell 11%, but it looks like they've ended up selling their entire 25% stake in a block deal. I understand some domestic mutual funds were anchor investors, so the disclosures will be quite interesting. And remember, this will have an impact on the net FIDI buying as well in today's market. So that's the first name. Second, couple of stocks where there were large blocks in the pre-open as well. Metro Brands, nearly 2% equity, and Shriram Pistons. In both the names, my sense is that the promoter entities were sellers in today's block deal. Interestingly, in Shriram Pistons, there was another block in the afternoon block window as well. 10 lakh shares got changed hands in the second half of that block window. Even there, the promoter entity was a seller. Some domestic mutual funds, couple of large FI funds were buyers in today's block deal. So again, disclosures in even Shriram Piston could be quite interesting. The third name is Blue Jet Healthcare, one of the recent listings, been buzzing in trade today and large buying as well. I understand some larger HNIs are quite active buyers, and hence a big move on large volumes in Blue Jet. And the last name is Vector Foods. There was a QIP which got launched last evening. Big move in that name as well, largely because I understand there is a very strong demand in the QIP book from larger institutions, hence a big move in Vector Foods as well today.
Oh yeah, Vectors is really flying high, 13% higher. Thanks very much. And Nimesh, I liked how you put it. It's a Friday, but this is a bit of a lethal cocktail for the bulls. I don't think this is the kind of cocktail they would have wanted on a Friday. Still dealing with a 300-point cut on the Nifty. Thank you so much for joining in. Well, just to complete that point and get that perspective on this whole FPI matter, we have with us Keyur Shah, who's partner and national leader financial services at EY India. Keyur, great to have you on the line. It's a really complex matter, so that's why I gave the background earlier. But just to come to the crux of the matter, the whole issue lies in who has got an exemption from this disclosure requirement and who hasn't. And I believe that this matter went up to SEBI. People are sort of making applications, and I heard maybe even going up to SAT. So what is the resolution, and what happens now that this deadline is taking place today?
So again, Surbi, I wanted to just break down the problem. Let's just understand what the issue was. 24th of August 2023 is when the circular was issued by SEBI. They said if you had assets in India which were more than 25,000 crores, or you held more than 50% in a single corporate group, then you needed to disclose up to your made disclosures up to your ultimate beneficial owner. And this came out in August, and then, as you rightly pointed out earlier, you had to comply by February, and if you didn't comply, then you had to start winding down by after February, and you had up to 180 days to wind down, which ends on 9th of September. Now, the only thing is that what we have seen is that, yes, you are right. Lots of people have made some application for exemption because they had said that if you were a regulated entity, you could make an application and SEBI would give you an approval. But also, look, this, as you pointed out, has been there for a long time now. It is more than a year that this circular was notified. So for most of our clients, at least, what we've seen is that those who felt that they were not going to be able to comply, they were anyway, slowly winding down or getting into what SEBI wanted. Because what SEBI also said is that if you have more than 25,000 crores, you please wind down and get within the limits. Or if you had more than 50%, you please wind down. So I don't think that this would be a cause of concern at a market at large perspective. Of course, there will be a few FPIs who would have made that application and therefore, would be struggling given that SEBI may or may not have responded. And that is something which we will need to figure out. But in my mind, it is not something which is a cause for a large disruption right now, because this is something which was known. It's not a big surprise.
Okay, got it. So I think from a market perspective, that offers us some relief and some clarity that this should not be impacting a very large cross-section of FPI. So we're not talking about massive AUM. Perhaps that has to be wound up or has to be sold down. So that would be some relief. But Keyur, just to complete the point, there was this China angle as well. I think there was some issue about whether an FPI is China-owned and controlled, and then whether that will be allowed or not allowed, will they sell?
Yeah.
So what are the remaining outstanding issues, and is there any reason to believe that we could get more volatility from an FPI perspective in the coming days as well?
So look, what happened was that after this circular was issued, I think there was a lot of advocacy which happened around this point. And people were asking, I think, SEBI in terms of what was the intent behind this circular. And then on June 30th, they came out, this year that is, they came out with a consultation paper, which has not yet got notified, whereby they said that, look, the primary purpose of this whole asking for ultimate beneficial ownership was to understand if you had people who are investing from land bordering countries from India. And this goes back to our whole press note 3 related issue in the good old days. And that consultation paper basically said that we will break up FPIs into 3 categories. And this is, again, only applicable to those FPI who fulfill this criteria, which is more than 25,000 crores and or having more than 50% in an single Indian corporate group. So they said that if more than 50% of your owners are from China, then you please intimate us and we will let you know what kind of disclosures you need to make. If you have less than 50%, but above 33% ownership of Chinese, then you need to fulfill this criteria and you need to make all the disclosures which are required under the August 24th circular. And if you're less than 33% Chinese owned, and I'm just using China as an example, it could be Pakistan and or any other country land bordering India, then you needed to, then you were scot-free, then you don't need to make any of the disclosures which are required. The whole thing around this was that people felt that then that would even be better, right? Because what you are doing is that while you had the overall threshold in terms of disclosure requirements, you are bringing this down further to say that only those people who are investing into India through a particular landlocked country were getting covered by this circular. So it was more of a dispensation making life easier. But unfortunately, that consultation paper has not seen the light of day yet. And therefore, we'll have to see how that one evolves. But it's only going to make life easier, not more difficult.
So, but basically, I guess the long and short of it is that the rules that will determine who gets exemption from the purview of this circular, those rules have not finally been decided, deliberated upon and formalized, right? We're still awaiting the formal notification and final rules from SEBI on that. Is that right?
Yes and no, in the sense that if you were fulfilling the criteria under August 24th, you had to disclose. If you, then what happened was on June 30th, they came out with a larger concession because they said that we'll restrict this only to landlocked countries. That concession has not been notified. Therefore, if you are under the overall umbrella where you were fulfilling the criteria under the old rules, you will need to disclose. So that's the way it is.
Okay, all right. Fair enough, Keyur. Thank you so much. Complex matter. One just hopes that this sort of settles and there is no immediate knee-jerk reaction as far as equity sales are concerned, in the market. Thank you so much for joining in and clarifying some of those important points. Well, that's a view on this whole FPI issue and whether we can see more volatility because of the 180-day deadline ending. With that, we'll take a very quick break, come back on the other side and get you more on the markets. Welcome back. You're with us on Closing Bell. Well, let's get you some perspective that we picked up from Manish Sonthalia of MK Investment Managers. He was with us earlier on the show, and he spoke about the present market context, the sectors that he's bullish on, and also some of the stocks that he would not own at the moment. Take a look.
It's a buy on dips. There is tremendous amount of flows that is coming into the markets. There is a bit of caution because valuations are not very conducive. Roughly around 25% of the entire market is worthwhile buying from a point of view of valuation. It's a pick and choose market. All of that is stays. But having said that, I think the caution will come around the time when you go through the fourth quarter. After the US elections are done with, you have new stocks coming into the F&O segment. All of that will lead to some sort of a volatility. So I think the stance is to make the portfolio a little bit more defensive. Take some beta off the table. I think financials is one area to hide. There's ample margin of safety out here. There is an IT, there is a farm. These are three sectors, and within that, individual stocks will have their own say. But these are the three sectors to basically go overweight on. And the ones to go underweight or slightly equal weight is basically your capital goods, railways, defense. I mean, they can go through some serious time correction, price correction. Specifically Zomato, which we own, I think the street will get surprised on numbers on FY 26, 27, and even 28, so to speak. So I don't think really that, this is one name where you have a case of an overvaluation. This whole quick commerce thing is tripling of dark stores by FY 26. I mean, it's yet to play out. So we are owners of that name. Not that I'm specifically recommending this name to anybody, but we think that the numbers that are going to come for 26, 27, 28 are going to surprise on the positive side.
Okay, that was Manish earlier with a perspective on the market. We have Hemang Jani now joining in to take us through the last leg as we get set for the festive weekend. Hemang, thanks for being with us. First of all, what do you make of the fall today? I mean, is it just pre-non-farm payrolls data jitter, something more? What do you think has led to this? Because usually every dip gets bought in this market.
Yeah, good afternoon, Surbi. Off late, we are not used to seeing this kind of correction. So when you go through correction in the index, about 1.5 or 2% also kind of, it comes as a bit of a, surprise. But I think it's very normal, the market cycles are such that either for the way things are globally or for the fact that the earnings season is over and there was not so much of excitement in many pockets, so you might see a bit of a correction here and there. I'm not reading too much into that. I think the fact of the matter is that the broader sentiment is good. You're just 2% away from the all-time high as far as Nifty is concerned. Of course, at stocks level, you may have slightly more correction, or in the broader market, there may be 5 or 10% kind of a correction, which is absolutely normal and healthy, I think.
Okay, fair enough. Let's talk about some of the key stocks that have been in focus today, Hemang. Vectors, obviously, this QIP has got the market's interest. Stocks up about 9%. Then there is a SBI card, which in a weak market is managing a 4% up move because of this Goldman Sachs note that I think the street has taken note of. Your thoughts on these two?
So as far as SBI card is concerned, I think it's been a stark underperformer for almost last 2 years. So now maybe some brokerage firms are sensing that you might see a bit of a revival when it comes to the growth in terms of credit costs and the fact that you don't have too many listed players when it comes to that space. But I think financials as a space has underperformed, and I would not be comfortable buying into that just because, there is a bit of a revival or the data point suggesting that. I would in fact stay away from the financials overall, though the valuations are comfortable because, the PSU as a space has not done so well. Things are not looking that great in terms of growth going ahead. So I would rather focus on the pockets where the actual earning delivery was there this quarter.
Okay, fair enough. I'm just taking a look at where the mid-cap pressure is coming in. Let's pull some of these stocks up on the radar. A lot of the PSU banks have been under pressure today, and some examples would be Canara Bank, for instance, is down about 4.5%. There is IDBI Bank down about 4% as well. Indian Bank is down 5.5%. So the entire PSU space, it's not just an SBI-related fall, though SBI is falling in step with the large caps that have been correcting today, but a lot of the tier 2 PSU banks are also under pressure. Ola Electric has lost 4.5%. And remember, Ease My Trip, Easy Trip Planners. That stock, after that huge move yesterday on the announcement that they want to manufacture EV buses, after yesterday's big spike up, today is a sharp down day for Easy Trip Planners. There you go, 6% on the lower side. Some idea of the kind of profit taking that's going on. Hemang, let me ask you about Easy Trip actually. I don't know what you made of the announcement. We caught up with the gentleman who's heading this EV side of the business. They're putting 200 crores to work. They want to manufacture 5,000 buses over the next couple of years. But does it add up for you? And what's the view on the stock?
So should we not, looking at this stock actively? And I think there is a complete sort of a unrelated thing that they're probably getting into. Honestly, EV as a theme, when you look at many companies, they have already done reasonably well in the market. But I don't think either in India or globally at this point, people are going to get so much excited about this kind of announcement. So you might see a knee-jerk reaction. But by and large, it would make more sense at these levels of the market to stick to the, names where that, next few quarters are going to be good in terms of earnings growth, or the defensive plays where if you get into some sort of a corrective mode, you're slightly better off. I think that approach would be much better at this point of time.
Okay, fair enough. Well, we just got about a minute left before the bell goes off. So, Hemang, you leave us with some thoughts and maybe even a pick or so. So today is the rare day when the market gave you an opportunity to get in and buy. What would be on your buy list?
I think should be this pharma space, particularly the CDMO API, because of the fact that you may have some act being passed in US, that can be a big trigger for some of the CDMO stroke API players in India, and some of the companies like Laurus Labs, TVs, and whole host of companies. I think it would make sense to relook at those, given the possibility that you might see a big, order flow and a much incremental visibility in terms of revenue coming from US.
Okay, all right, Hemang, thank you very much for joining in. Thank you for the perspective. You have a great weekend, and we'll see you with the markets again soon. Let's start winding down the week and the day. Well, first, the tally for the day. This is a cut of about 1.1% on the Nifty. For the week, the decline is about 1.5%. If you look at the mid-cap index, then the weekly tally is a drop of 1.3%, and a lot of that damage actually happened today. The Nifty Bank also down about 1.5% for the week. So all the indices on a weekly basis have given up about 1.5%. Today's story, of course, is that the wider fall or the bigger fall came in the mid-cap index and the Bank Nifty. Let's start by looking at the large-cap screen then. A lot of financial names on the way down. For instance, look at SBI. It's ending with a cut of almost 4.5%. ICICI Bank down about 2.5%. There were other big stocks as well. Reliance down 2%. There is something like ITC that lost about 2% as well. Infosys losing about 1.5%. L&T down 1.5%. So big large-cap fall is what we have. Bajaj Finance managing green because its subsidiary will be looking out for the IPO come next week. And that's a stock that held out in positive territory. Some buying continued on Asian Paints. If I talk about the movers and shakers on the mid-cap screen, because that's where the large part of the selling was, then in the stocks that I was just naming, Indus Towers down about 4.5%. Vodafone Idea, massive cut there on the back of the Goldman Sachs note, 11% gone from that stock. Raymond Lifestyle, which listed just yesterday, is down about 5%. Some of the other names are IIFL Securities, there's Walk Hard. These are the names on the downside. Easy Trip, the stock we were just discussing, losing about 6% as well. On the upside, again on brokerage commentary, SBI Card had a good outing, swiping in the right direction, 4% up on that stock, and Vectors on the QIP issue up about 10% as well. So these were some of the major movers. And Premier Energies, what a listing, what an IPO this has been. Stocks up 9%. Putting on a lot of weight and momentum after the listing. It's already become an over 1,100 rupee stock. So that's the way it played out. Well, the bell has gone. The week has come to an end. And now it's going to be all eyes on that non-farm payrolls data when we come back to trade on Monday. For now, it's a wrap on Closing Bell and goodbye from the team that puts the show together. But don't go anywhere because our Friday special offering, Editors Roundtable,